from stability to steering. Originally, monetary policy aimed to stabilize. Now it increasingly steers. Interest rates no longer just respond to inflation. They influence housing markets, employment trends, asset allocation, even political cycles. Liquidity is not just emergency relief. It is a directional signal. Cause-effect frequent intervention prevents collapse. Markets anticipate intervention risk increases. Intervention becomes expected at some point. Support is no longer extraordinary. It becomes embedded. And when participants assume support, discipline weakens. Digital money, the next layer. The next evolution is already underway. Digital currencies. Programmable money. Central bank digital currencies, CBDCs. On the surface, these tools promise efficiency, faster payments, reduced fraud, greater transparency. But digitally programmable money carries a new dimension: conditionality. Money that can expire. Money that can be restricted. Money that can be directed toward approved uses. This is not dystopian fiction. It is technological capability. And capability always reshapes systems. Why crisis accelerates control. Every major expansion of authority in history followed instability. War expands state power. Depression expands monetary authority. Pandemics expand emergency measures. Permanent crisis creates a permanent justification. Because urgency overrides debate. Speed overrides restraint. And once infrastructure is built, it rarely disappears. Temporary tools become standing mechanisms. The incentive problem. Here's the deeper structural issue. When policymakers prevent downturns quickly, they inherit larger responsibility next time. Cause-effect rescue reduces immediate pain. Expectations of rescue increase future risks. Grow future rescues become larger. Each intervention solves a short-term issue while increasing long-term sensitivity. The system becomes more stable day-to-day, more fragile structurally. It resembles a tightly stretched cable. Strong under tension. Vulnerable if slack disappears. The human response. Inside this architecture, people change. They optimize for short-term gains. Leverage. Speed. Why save patiently if liquidity will arrive? Why price risk conservatively if downside is cushioned? This doesn't require corruption. It requires incentives. And incentives shape behavior faster than ideology ever could.